Hello guys, welcome to Trust Forex Academy. My name is Anderson Priye, and in this video we're going to be looking at some words frequently used in the Forex markets. Before we get started, feel free at any time in this video to pause the video, go back and forth until you get the full idea that is being shared. Forex is a concept that must be slowly learnt. Go at your own pace, make sure you understand what is being taught before you move forward. That said, let's get started. Spread. What is a spread? The spread is what your broker charges you to execute a trade. It is a difference in price between buying and selling the base currency. Let me explain this from what you can see here. You can see these two lines, they are both price lines, okay? They're both price lines, and then they're just a difference of about one pip thereabout. 1.18455, 1.18449. The difference between these two lines, both of them are price lines, okay? Look at them here. The difference between them is just fraction of a pip, okay? And then that difference is what we call a spread. That spread varies from one broker to another, or from one type of account to the other. That difference is what the broker charges you to execute that trade, depending on the type of account that you have. So you want to check for spread most times, because it could affect your trading conditions. When you're entering a trade with someone, if your spread is wide, you could be at a loss when somebody with a smaller spread is already in profit, okay? So these are a few things that you must look after, okay? Volatility. Now, this is when the market conditions begin to change rapidly and price begins to move faster, okay? When there's volatility in the market, things happen very quickly in the market. Price moves in one direction very quickly, okay? So what happens here, when there's high volatility, big moves happen, longer candles, understand, like we could see in this chart, there are longer candles forming, like that. And then one of the reasons is major news happening at that time, okay? So when there's low volatility, it means that the market is slow, or there's no news at that time, or nothing is influencing the market, or maybe the market is closed at the time, okay? Liquidity shows the number of participants that are actually in the market per time, okay? So the more the participants in the market, the more money, or the more trades, the more volume in the market at that time. So when there's low liquidity, it means that there are few participants, and that will not be a good time to trade. If there's high liquidity, it means there are a lot of participants in the market, there's a lot of money in the market at that time, there's a lot of volume, and then it will result to a lot of volatility, and then it's a good time to catch some pips. Volume is the size of orders that have been put in by the market participants. The volume in the market tells us how much money is in the market, or how many positions are opened in the market per time, okay? And this could be influenced by the session. There are sessions that have low volumes, okay? There are sessions that have higher volumes. Holidays, there are no volumes because there's nobody in the market. There could be fundamental influence like news, it could be natural disasters, there could be some political influence that affects the decision of market participants per time, and like so. Volume, it just shows the size of orders that are in the market at a particular period of time. Next we'll discuss is consolidation. Consolidation is when there is a lot of nothing happening in the market per time. This means it's going this way, and then the other means it's going the other way, okay? So on the chart you will see some sideways movement, like what you could have here. Market is consolidating at this point, before a move towards a direction. Market is consolidating here before the move downwards, and like that. So this happens frequently in the market when there's a lot of nothing happening. You just see the market going back and forth around the period. We call that consolidation, okay? Market price. The prevailing exchange rate of two currency per time is what we call market price. Market price is often shown by two lines, the ask price and the bid price, often differentiated with a few pips. Okay, so look at this. You can see these two prices here. One is the ask price and one is the bid price. Okay, so differentiated by a few pips. Sometimes it could be less than a pip, understand? So that is the market price per time. This is important to know. You could see these indicators here: sell by market, buy by market. Okay, it means whichever one you click, you're buying, you're entering the trade at that particular price, at that particular market price per time. Okay, now you'll hear us often use the word buy in the forex market. Buy could be synonymous to some other words like long, bull, hawk. Okay, so we could say go long in the market, we could say go bullish in the market, or go hawkish in the market. We place a buy when the market price is expected to go up. Okay, so we place a buy when price is low. Let's take for instance, the price is down here and then we foresee that price is going to go up. It is good you enter a buy from somewhere here and then go up. The market consolidates at this point and then we enter another buy and it goes up. So buy in the market means entering the market at a price when you expect the market price to go higher than the current price. The next thing we'll discuss is a sell, the opposite of buy. It has its own synonyms also. You could have short, bear, or dove. Okay, so when we say go short or go bearish or go dovish, it means that we expect you to sell. Okay, now you sell or you place a sell when the market price is expected to fall. Look at this chart. You can see that the market price is falling down. So at this point, if you place a sell, you'll be in profit. When it goes down, it makes some retracement back and it goes down like so. Sell is what you do when you expect. Sell is the position you enter when you expect the market price to go down. Candlesticks. Now, candlesticks is one of the terms you hear when we do technical analysis. Okay, so these sticks are also called Japanese candlesticks. Now, a pictorial representation of price action per time is what a candle is. Okay, so each of these candles you can see pictorially represents price action, what price is doing per time. Okay, the parts of a candle are open, high, low, and close. So every candle has a point where it opens. Every candle has a point where it opens. It has its high and it has its low and it has its close. Okay, so we're going to discuss all of those later on. Okay, a candle is made up of wick and body. So you can see the wick of this candle here and you can see the body of the candle. So there's some candles that may not have wicks, but every candle but has body, and there's some candles that do not have body but have wicks. Okay, let me look for an example here. You can see the body in this candle is big and then has small, very tiny wick. But you can see one here that has no body but has wicks up and down. So it just basically tells you what the price is doing per time. Okay, highs. Now, what's a high? The highest price level the market reached in a swing. Okay, so it means that when the market price swings to a certain direction, the highest point it reaches at that time is what we call the high. This could be marked by the wick of a candle or the body of a candle. Okay, so for this chart you can see the highest point it got is here. So in this chart we could mark this as the high point of the chart. I mean, the highest point where price reached in this given period. Lows. Low would mean the lowest price level the market reached in a swing. Okay, so let's say look at this swing, the market came down here and this was the lowest point it got to. This could be marked also by the wick or the body of a candle. Okay, so this is the lowest point that the price reached. The next thing we'll discuss is an uptrend. What's an uptrend? An uptrend is a situation where the market is going upwards. Okay, from the chart you can see the candles forming are going upwards. Okay, now other words for uptrend is bullish or hawkish. Okay, or we could say the market is long. Okay, now an uptrend is when the market makes higher highs and higher lows. Okay, so look at it from the chart. You can see that this is a high point here or a high point here, and this is the low in the market. When the market moved upward, it made the high that is higher than this one, and when it came down, it made a low that is still higher than this low. Okay, so this is a higher high, higher than this one, then a higher low which is higher than this one. The next move it made another high that is higher than this previous high, and made a low that is higher than this previous low. Okay, so when you see the market making this move, this is called an uptrend. In such a market, you want to have long-term buys. Okay, you could stay in the market longer when your position is a buy, and if you're entering a short position or if you're entering a sell position, you want to stay short. You want to stay in the market for a short period of time. Okay, the next concept to discuss here is a downtrend. What's a downtrend? A downtrend is when the market is seen going downwards, when the price in the market is going downward. Okay, other words for downtrend is called bearish or dovish. We could say the market is bearish over the past 1 month, the market is bearish over the past 2 weeks, and like that, depending on the time frame. Okay, so a downtrend is when the market makes lower highs and lower lows. An example will be this. If you look at this point, this is a high and then this is a low from what we've thought. Now when the market made this swing down this way, you can see that it formed a low that is lower than this previous low, and then when it went up in retracement, it formed a high that is lower than this previous high. When this continues, we can say that the market is on a downtrend. In such markets, you want to be in a sell position longer, and then if you're entering a buy which is opposite of the trend, you want to stay there for as short as possible the time. Okay, the next thing we'll talk about is overbought. When the market is overbought, this is the best time to sell. It means there's no more volume above in the market. Now the overbought can be marked by the RSI indicator, the relative strength index indicator 70 and above. So you can see that here 70, but you can see that this line has crossed 70 to about 80-85 there about. So once the market gets to 70 on the RSI line, you can safely say that the market is overbought. Now you must take note, do not fight the trend. Okay, do not fight the trend. The market can still move beyond that, but it's just a term that you hear people use over time, say the market is overbought, and when we say that, it means there's no more volume up there, or the buyers are no longer placing more positions in the market. Another concept to discuss is oversold, which is the opposite of overbought. Okay, this is the best time to buy. It means that at this point there is no more volume below. The sellers are no longer placing their volumes. The sellers are no longer holding their positions in the market. Okay, this is marked by the relative strength index 30 and below. You can see 30 here, and you can see that the price could get there and even go below that. Just like the overbought, do not fight the trend. When the market goes down that way, take note, it can continue going downwards. It doesn't mean that when you see the market at RSI 30, you can just safely enter a buy at that point. You have to still be patient with the market and then to see what happens afterwards. This is the end of this session of Forex vocabulary. We'll make another video to give you more terms that are used in the Forex market. We hope that you find these ones useful, and then when you hear them in any Forex class that you attend, be sure to recognize what they mean. Thank you guys for this video, and I'll see you in the next one.